Hey, old dogs. I just want to take a moment to welcome a new sponsor to the show, Smart Move. Smart Move is the best way I know to protect yourself from evictions and bad tenants. Smart Move has a special offer just for Old Dog listeners. Just go to tenantscreening.com, enter code OLDDOG25 at checkout, and you'll get 25% off your next screening. That's tenantscreening.com, enter OLDDOG25, and get 25% off your next screening.
This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is a show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. Well, we've got a good show for you today. We're going to be talking about an area we really haven't had a focused podcast on as of yet. This subject matter is in the area of REITs. If you don't know what a REIT is, you're going to find out shortly. We have a guest here who is an expert in that area. His name is Minesh Bhindi, and he's the CEO of Perfect Portfolio, a company that teaches people how to manage their wealth and create portfolios that work for them and their families. He's been involved in investment education for 12 years and has clients in over 46 countries. Well, Minesh, welcome to the Old Dogs REI Network.
Thank you very much. Honored to be here. I think what you're doing is fantastic. We haven't really known each other for too long, but everything I know about you so far feels good.
That's great. That's great. Well, you are talking to us from, it sounds like you're far away here. Are you in another country?
I'm in London. I'm from London, but a lot of people in America, they don't confuse my accent, but in London, people think I'm slightly American. I guess that's because I started traveling when I was very young to the U.S. I love the States.
Oh, that's great. That's great. Yeah, I know you've got something going on in San Diego area, south of me here. I'm in South County, Orange County in California. So I know there's something, at least an office down there which is great. Yeah. Our folks always like to know our guests and find a little bit about their background and where they came from and how they got involved in real estate and investments. If you would mind sharing your story with us.
Yeah, I've got a funny story for you. So I was, my dad's always been involved in real estate. And I was 15 and a half years old, and I'm walking past his home office. And I hear him negotiating a real estate deal. We used to work with new build properties that the managers just wanted to let go of so they could move on to the next development, right at the end of a development, basically. And so he's negotiating this deal, and I'm standing by the door, and I'm just watching. And in my head, my arrogant self is going, it sounds pretty simple to me. I mean, I don't know what's so complicated about this. And he got off the phone. He said, "What are you smirking at?" I said, "I I could do that.
Right.
And, right. And instead of telling me to screw off, basically, he very luckily for me said, "Well, show me what show me what you can do, show me what you've got." And at that point is when my balls found my throat because it's sort of like I wrote a check that I was unsure whether I could cash or not, right? In that moment. But very quickly after that, I had to figure it out. So I started learning about real estate, learning how to deal with lawyers, learning the terminologies, learning how to deal with mortgage brokers, and all while I'm still going through high school in the United Kingdom, right? And luckily for me, and this is one thing I didn't know until afterwards, was that because I didn't have a fear around making a deal happen, because it was my situation was either we're going to do this deal or I'm still going to go back to high school, right? Because I didn't have the fear of walking away from a deal, I started getting better deals than all the people that were involved with my dad's consortium of investors could find. It was just a very, very simple process for me, and it became effortless and fun. And so our main business at that point was packaging, negotiating, say, 12 remaining units out of a development, getting a 25% discount, packaging them up and selling them to the investors that were part of the network. Very, very simple business. And that was my first ever introduction into real estate.
Oh, fascinating. Now, was this happening in London or in that general area?
Yeah.
Interesting.
Yeah, in London, in the financial district of London, which is called Canary Wharf. And it's also where I did my first deal as well.
You're still in high school when this is happening, right?
Yeah. I've still
crazy.
got to worry about my high school exams and things like that. And, I'm during lunch breaks while everyone else is playing football, I'm on the phone to the lawyer or the mortgage broker for the client or a property manager, et cetera, et cetera.
Now, did you go into university and focus in finance or that area, or did you just jump right into real estate?
I tell you what, I didn't. And I didn't go to university simply because, and again, a lot of decisions I've made have come from a very arrogant, self-believing state. And it felt very arrogant now that I look back on it. But back then it was just completely a no-brainer. And that was, I went to meet all the professors in university after, at the end of high school. Bear in mind, at the end of high school, I'm making almost $100,000 a year by selling these deals to investors, right? And I'm just about to complete on my own deal at 18 years old. And I went to meet all these professors because that's what they do, university open days and things like that. And I had zero respect for any professor that I met, simply because I knew my goal was I wanted to make money. And none of them were teaching me how to make money. They were teaching me how to read and hold information. So from that state, some people say luckily, some people say, that was kind of arrogant. I just came to the conclusion that these people don't have anything to teach me. Now, that's obviously wrong, right? But in that moment, it helped me out because it gave me the confidence to go, no, I'm not doing that, especially coming from an Indian family with a background of you have to go to university, you have to study, you have to do this. So no, I didn't go to university.
That's awesome. And your father, he wasn't making a big deal out of the university. He was just basically saying, "Hey, this kid's making money here."
My dad knew. My dad could see it. It was my mom that was the challenge, right? My dad could see how I was negotiating deals and how I was talking to lawyers at 16 years old and finding creative solutions to things that the lawyers couldn't think of. Like he knew what I was capable of. My mom was the one that was terrified.
Yeah. Oh, I'm sure. Wow. Well, that is a fascinating story. You obviously have continued in that area. Now you were saying you're packaging, their developments and you're working specific. Are you still in that area, or are you, have you moved into other types of investments?
Other types. So we were doing something that was, now looking back on it, a very, very cheeky approach to making a lot of money with real estate. We were working in that time period in London just before the crash, where we could walk into a valuer's office and say, we want this valuation on this list of properties. And without getting up from his chair, he would write the report, right? We were working in a time where we could tell the finance company that the mortgage company, we want you to use this valuer's valuation. We were working in those times of free credit, and everything was great, right? And so in those moments, we leveraged that to make money out of that situation. And obviously, a lot of people lost money. A lot of people got hurt in that time period as well. We were, fingers crossed. Luckily we weren't, on that side of the game. So yes, that time is gone. They've smartened up. Unfortunately, for some.
And after the crash, did you sort of rethink what you were going to do? How did you sort of readjust your business model?
Yeah, so when I was 18, a friend of mine, and he used to run seminars and things like that, and I went to attend this seminar again, dragged along by my dad, right? Because at that point, I was like, I'm making almost $100,000 a year. I don't want to do anything. When you're 18 and you're making that amount of money, you're the richest guy on earth. It doesn't matter what anyone says.
You're thinking nobody can teach you anything at that point.
Nobody can teach you anything, right? So he said to me, I went and spoke to him. His name is Mark Anastasi. And I went and spoke to him at the back of his seminar. And by the way, I'm 3/4 of the way through the seminar, and in my head, I'm deconstructing and thinking how much crap people are talking on stage, right? Just complete arrogance. And I went and spoke to him at the back, and I said, look, I don't know why I'm here, but Dad dragged me here. What is this business actually about? Like, tell me, I've always been pretty much of a straight shooter when it comes to conversations. And so, he said, what do you do? And I told him everything that I was doing. He goes, you need to be on stage. And that was almost like an insult to me at that point, right? I need to be on stage. What are you talking about? I don't want to do that monkey business that you guys do. And he said, how about this? He goes, what you're not realizing is you can help so many people actually get results like what you're getting, right? And if you think that there's loads of people on stage that are talking shit, basically, then it should be a feeling of responsibility that you have to try and help people. It's sort of like the same inspiration that you have for this podcast and everything that you do, Bill, right? You want to help people with the experience that you've had. I didn't want to help people with the experience that I had. I wanted to make money at that point. And then I saw him go on stage, and the agreement we had was, he said, look, we're not going to get anywhere with this conversation now. How about this? Watch my talk. It's 90 minutes long. I'm on next. And then let's have a conversation afterwards. And I think secretly he knew that I was motivated by money at that point, right? So I watched his presentation. I'm sitting on the inside of the aisle, and I'm there. And at the end of it, I'm basically going through in my head why everything he's saying is a bunch of bull throughout his whole 90 minutes. And then right at the end, I see 100 people run past me, banging my shoulder to go and give him £2,000 each to learn something that for a seminar that he was going to run in 3 months' time. He had no deal to work out, nothing to do, no actual real estate work, none of that stuff to do, right? None of the actual work to do, and people were paying for that. And I turned to my dad at that point and I said, I could do this. And that's what at that moment got me into education. And it might not have been the right entrance into education and doing the right thing, but the great thing about it was I had the people around me right from the start so that I wouldn't go down the path that a lot of people do, which is saying anything to make a sale. I had people holding me accountable from that point. That led all the way up to 2008. 2008 happened. By then, we had a company teaching real estate and a company teaching how to trade in the stock market. The one with trading in the stock market took such a hit because of what happened in 2008, and we were teaching people how to use leverage and things like that. But psychologically, it completely screwed me up. It was almost a feeling of, I am handing someone a gun and they're taking it and pointing it at their own foot, pulling the trigger, and I'm taking no responsibility because I have a disclaimer signed, right? That really screwed me up. And so I had to take a year out of that and just take a mental pause. And then after that, I realized, I think more so than making the money, more so than anything else, if I could help people understand that safe investing can be exciting, I think I could do a lot of good in the world as well with the skills that I've developed over this period of time. And so when I came back in 2010, that was my intention, to make safe investing exciting. And by then I was sort of on my way out of doing real estate in the way that we were doing it and moving towards REITs. So that's sort of overall the transition that happened for me. It went from a purely money-based motivation, which I don't think is bad. I think money is a great motivator, but it went from purely that to really, trying to actually make a real difference in people's lives.
Gotcha. It's interesting, though, that even though you sort of got away from real estate in terms of, dealing with properties, you went into REITs, which, still, talking about a real estate based product. Was that intentional? I mean, because you talk about a safe investment. Did you see that because it was a tangible product like that it had maybe a little bit more to offer than just stocks and bonds and so forth?
Well, I'm a big fan of stocks as well. I'm a big fan of the U.S. overall. I'm a big fan of, I don't trade stocks, one by one. I'm invested in index funds. So I'm a big fan of that. In 2010, after the period of taking time off in 2009, I started putting money into gold and silver. So I'm a big fan of real tangible assets. The real estate one, the reason why I went towards REITs is that I think the average person that actually wants to create any success in their life, I think they want things that are very, very reasonable. I think most people that are listening to this podcast want a life where they have some security. They want a life where they have some financial freedom. They want a life where they have some time freedom. They want a life where they can provide some security for their future generations. And they want investments and they want businesses that don't turn them into slaves. That's what I wanted. It was a funny story. In 2011, I had a tenant of mine call me at 11 p.m. on a Saturday evening and say, "Hey, the light bulb's gone out." And I said, "Well, there's lots of spare light bulbs in the closet. Just change them." And he said, "No, my contract says I have to call you." And this was a property that wasn't managed at the time, right? So you can guess what happened after that. 11:30 at night, I'm in a car driving 30 minutes to go change a freaking light bulb in a property for a guy that couldn't be bothered to do that, right? And so on the way there, I was steaming about how real estate is. And then on the way back, I was planning how to do it the right way with everything that I'd learned since coming into gold and silver, coming into the stock market and everything else. So that was the reason for the transition.
Now, so you did own rental properties then at one time?
We still do. We haven't got rid of my philosophy on real estate is you buy and hold forever. There is no selling.
But are you having other people manage them? Are you involved in that process?
Definitely.
Okay. And what are they? I mean, flats, like you call them?
Yeah, apartments. Yeah.
Yeah. Okay. So apartments and
apartments and houses.
It's in the greater London area.
Yeah, mainly in the home area that I started in, which is it's an area called Canary Wharf in London, which is the financial district.
Okay, great. Well, that's so interesting. You had this expertise you were developing in investments, and it sounds like you definitely were benefiting there. But you also had the real estate as sort of an additional stream of income. Is that how you looked at it?
Real estate is a vital part of a portfolio, and it's always, as long as you're diversified, as long as you're not doing stupid things like buying in a town that is only existing because one company has a factory there, you're going to do pretty well. As long as you stick to prime real estate, as long as it's managed well, as long as, the focus is not, oh, I'm friends with the tenant, but the focus is I need to generate the maximum amount of cash flow. I need to buy the deal at the right time. As long as you've got all those business things and that business acumen, real estate's going to be a really great investment, especially with the world that we live in, right? So I'm a fan of real estate in cities. I'm a fan of real estate that allows you the ability to attract professional clients, et cetera, et cetera.
Now, you manage folks' portfolios, it sounds like it, at least from your bio. And what percentage of a person's portfolio do you recommend being in real estate?
Well, officially, I've got to correct you. We don't manage people's portfolios. We're only educators as far as perfect portfolios.
To manage.
Yeah.
Okay, got it.
Yeah, but from my experience and the studies and the models I've run, you need about 40% in real estate.
Right. And why is that?
That sort of provides the right balance because the problem is that the stock market, for example, over time will grow more than real estate. But real estate is a great foundational growth, and it provides great cash flow as well. So about 40% seems to be the right number from everything that I've run.
And the yields, are you focused on the yield of those real estate instruments?
Absolutely. So my goal really is to focus on on average an 8% compounded growth of the actual property. And then we're aiming for, the REITs that we use, you're looking at it's 8.48% compounded growth since inception, 4.52% dividend yield, which is the net cash flow that you're receiving on the property. And then we use different vehicles in the market to boost that up by another 12% a year.
Got it.
So you're looking at 8% compounded capital gain and then another 16% on the cash flow.
Well, since we're there right now and we've talked about, can you just kind of define for our listeners what a REIT is and how do you invest in a REIT?
Sure. So a REIT is, in essence, a company that has a special status for a REIT. And these REITs, these companies, own and finance income-producing real estate in a wide variety of sectors that have to meet certain criteria to qualify as a REIT. Now, the good thing about a REIT, and we use REIT ETFs, which is one step above a REIT. So there's hundreds of REITs, and a REIT ETF basically is an ETF is a fund that trades on the stock market, right? So a REIT ETF basically takes all that money in and invests for you into multiple different REITs. And so you're doing even less of the work that you have to do. You've got, the smartest geeks on earth doing the analysis inside of every single one of the REITs in the market and then allocating your money for you with the sole goal of making you the most amount of money that year because they want to attract more investment to that ETF.
Sounds almost like a money market fund for REITs.
It is not a money market fund, but yeah, I get what you're saying.
You're grouping together multiple different REITs from multiple different companies, right?
Yes, exactly. Mm-hmm. And so the best bit about that is, with one ETF, one REIT ETF investment, you're invested in, 8 different sectors of real estate and 154 different real estate opportunities.
What does ETF stand for?
Exchange Traded Fund.
Okay, got it. All right.
Yeah, so the Exchange Traded Fund basically owns an underlying security. In this scenario, REIT ETF, the Exchange Traded Fund owns the REITs which are underlying it. So, and then those REITs go and do the investment.
And REITs are real estate investment trusts, right?
That's right. Yeah.
So this is a licensed instrument versus, let's say, crowdfunding or something of that nature, where you can buy into various, investments that are real estate as well, right?
That's right. This is completely licensed. There's $64.2 billion worth of wealth being stored through one of the REIT ETFs that we use. The fee for doing this, because obviously you've got the economies of scale, right? You're not paying 10% a year or 5% a year or 3% a year or 2% a year to managers that don't care whether they make you any money or not. Your fee for this is 0.12% a year. And by the way, the dividend is 4.52%. Without you even doing anything else. So there is a huge arbitrage just based on that. And again, like I said, you're diversified with one stock purchase. You're diversified into 8 different real estate sectors and 154 real estate holdings with one purchase.
Now, do you deal specifically with individual REITs as well as the ETFs, or are you only working with ETFs?
We only work with ETFs.
Gotcha. And are there higher risk instruments? I would, imagine like with other types of stocks and so forth. Are there higher risk and less risk? I mean, how do you know how to pick an ETF?
Yeah, there are definitely ETFs that are scary when you look at what's actually inside of them. And some of them are leveraged ETFs, which means, if it goes down, $1, your ETF goes down $3, for example. And some of them are negatively leveraged, which means if it goes up $1, you're down $3. So it's a very interesting world. You've got to know which ones to look into and which ones to look at. The standard one that I think a lot of people will find if they just Google, it's the biggest one, is VNQ. And that's a very, very stable one to use. We definitely use that one for our clients.
And how does somebody evaluate an ETF to know, just how solid? Is there a rating, or something that or do you have to just look into the individual companies and their history?
Well, most of the time you're looking at which ones have the best track record, which ones have have the best providers behind them, and VNQ is provided by Vanguard, which is one of the best track record companies for providing these sorts of services. They came out with the first, index fund structure that was created as well. So they do a pretty good job at that. But other than that, it's got to be on an investor basis of what you're looking at, and you've got to create your own rules for that, which is what we've been pretty good at.
What are the minimum investments for an ETF?
You can get started for about $10,000, but most of our clients are doing somewhere between $50,000 and $250,000.
And is there? Can you pull out any time? Is it just like a money market fund in that regard? Do you have to? Are there specific terms that you have to stay in it for 1 year or 2 year or whatever?
That's the best and most dangerous thing about REIT ETFs, and that is that it's absolutely liquid. You can press sell and be out at any time. You are completely in control of your money. It's not like a traditional real estate portfolio where you and I both know, if you suddenly need to liquidate, you're taking a hit on that because you want a fast sale, right? So you get to liquidate at the market price anytime you want. There's no tie-in periods or anything like that. It's also the most worst part about it, simply because it makes people trigger happy. And the only way to invest long term is by staying in the investment. You keep coming in and out of investments, and you're going to shoot yourself in the foot before you even start. So that's the one thing I don't like about it. But that's why I try and warn people, like, you're getting into this for a long-term investment. This is not a short-term thing. You are not trading in and out of these things. It's just like buying a property. If you buy a property now, you're holding it for years.
And this Vanguard product that you're talking about specifically, what kind of yield has that had over the last year or two?
It's the one that I described. So since it's got an 8.48% compounded return and a 4.52% dividend, and with the strategies that we use to generate further cash flows, you're looking at another 12% a year.
Got it. So you're teaching folks how to manage their wealth and create portfolios. I assume you are also investing yourself, right?
Absolutely.
Okay.
Yeah, that's why that's why people ask us that. And I say that's why we only take 155 clients a year, because I used to take a lot more, and I've just realized that if I have any more than 155 per year, it starts draining my attention from my own investments. And I know for a fact that my own investments are going to make me more money and more wealth than anything I could do teaching-wise.
Interesting. But it's, again, it's so interesting just to hear your story. Young punk kid out of high school here jumping in and just, learning as you are. And it sounds like you just learn as you experience it, and probably through mentors or other people that you may have come in contact with. But what would you say was sort of your biggest mistake early on in investing like this, and what did you learn from that's affected your focus going forward?
Yeah, the biggest lesson I had to learn was that making money is easy. Keeping it is the hard part. And, I think that was the biggest one that I had to learn. A lot of people work so hard and are so frustrated because they don't know the formula to making money. Unfortunately or fortunately, that came easy to me. The hard part was learning how to keep it. And so, when I did my first real estate deal with just 3 apartments in Canary Wharf, I walked away. I put 1,500 down, and I walked away. I mean, in U.S. money, it would be what, 85 grand on the day of completion as a cashback, and about 300 grand in equity. And the first thing I did was go to Monaco that weekend, right, with my friends, and it was like, that was so stupid. I bought a Bentley when I was 23 years old for no reason, because I wanted to prove my ego right. Because when I was 13, my parents said, we were driving and there was a beautiful Bentley next to us. And I said, oh my God, what car is that? And they both said, that's a Bentley. That's way too expensive. That's not for us, right? Mercedes was fine, but Bentley, that was pushing it. So I always wanted to buy a Bentley when I was 23. Rather, I said I would buy it at some point. I happened to buy it when I was 23. Another stupid mistake. You can't drive the damn thing in London, right? It's like the roads are so narrow, it's unreal. So you need a chauffeur just to drive you around in that thing. So I got rid of it in 6 months. But again, silly things like that I lost money on simply by trying to prove things to myself or trying to make myself, I guess, feel better or on some level, like something like that. That was my biggest lesson, that making money is actually the easy part. That keeping it is the hard part. So get good at keeping it, because then you don't need to make a lot.
Now that's kind of a very wise advice there. But at the same time, what about as an investor? What was sort of your worst deal, and how did you learn from that?
All right, what was the worst deal? I think the worst deal was one where I had a client of mine who, because it was an investment consortium, right? So everyone sort of knew each other, and this particular client tried to go behind our back, or behind my back, I should say, to get the deal, and that sucked from a business perspective. So that would be that was the worst one. I lost so much money on that deal. But beyond that, to be honest with you, I've been pretty lucky. Touch wood. I've been pretty lucky. I haven't had a situation where I've had a terrible deal, and that's because my mentors always told me, you make money when you get into the deal, not when you get out. So I was always very, very, very careful to analyze the deal right from the start. And only once everything was in line, then would I get in. And so I was very lucky on that front. I know so many people that have just rushed into deals and they've they've been screwed by that. But I was so lucky that I had the right people around me. And that's what we try and do for clients now. Just be there for someone to talk to, just so they don't make silly mistakes.
Are you more conservative investor now than when you first began?
100%. And that the difference is that when I first began and what we were doing, we weren't actually, when you think about it, we weren't actually investing in real estate. We were playing the credit game, right? We were taking advantage of the credit situation and the credit markets at that time. We weren't actually, the purpose was, real estate was the vehicle, but we were actually taking advantage of the credit game at that point. So absolutely. Now, when I'm actually a long-term investor, I'm much more conservative now than I was back then.
What would you say is your biggest success as an investor?
Oh, that would be my first ever deal, simply because I'm the most proudest of it. It was 3 apartments in Canary Wharf. Like I said, 85 grand on the day of completion hit the account, and 300 grand in equity, and I put 1,500 down to do the deal. It was like, this is cool. I was addicted to that after that.
Yeah, our audience, as I mentioned to you earlier off the air, is that there are folks that are 50 plus in age. They're either approaching retirement or they're already in retirement, and they're looking at real estate as a means to be able to provide cash flow. Some of them already have their nest egg, and they just want to make sure that nest egg maintains its value and grows in value, hopefully also providing cash flow. What kind of advice would you have for those folks that are looking at real estate investing as a means to help them in that area?
Yeah, interesting question. I mean, and that's really what I spent a lot of time thinking about because I've always been around older people since I was 16 years old. Obviously, I'm dealing with real estate. I've always been around older people. I've seen the transitions that have happened. I've seen them, I've seen the kids leaving. I've seen the retirement pay. I've seen everything from that perspective. And I think the number one biggest piece of advice that based off of the mistakes that I've seen other people make, because obviously I'm not there yet, and that was just avoid any risk that could lose you a large chunk of your net worth. Most people are at a point now where, if they just stay stable and they stay safe and they stay secure, their wealth will grow. It will be fantastic. They'll have a great life. They'll leave the legacy that they want to leave. My problem that I've seen over and over and over again is that one deal that just looks too sweet to be true, comes along and someone loses 50% of their net worth on that one thing. And so that, to me, is the biggest thing to avoid at that age range.
When you're analyzing a deal, and just following up on what you said, when you're analyzing those deals, are you sort of looking at your best case, worst case scenario here?
Yeah, it's slightly different analysis when you're using REITs versus when you're analyzing a real estate deal. When I was definitely analyzing a real estate deal, I know I'm more worried about the worst case scenario because, if you take care of the downside, the upside will take care of itself. That's why I absolutely believe, especially with investments like real estate, for example. So I was absolutely more worried about understanding what is the absolute worst case scenario in an investment. That was primary for me. As far as the REITs go, you're more so looking at a diversified portfolio. So it's not based on one deal. It's not like your particular building is going to turn into, a whorehouse, and then suddenly that reduces the value of your particular property because it's in that building, right? You've got to concentrate. With real estate, doing it the traditional way, you've got a concentrated risk unless you've got a large number of apartments or a large number of properties. You've got a real concentrated risk. It's not like one company can move out of the town and ruin the investment, right? Because with the REITs, you're invested in 8 different sectors and 154 different real estate holdings. So you're pretty diversified from that perspective. So from that point, the real analysis that we do is how much cash flow can we pull out of this, and what's been the performance so far and the capital growth of the fund. But that turns more into a cash flow argument rather than a particular deal argument.
Yeah, it's interesting. Just what you said there is the fact that you're talking about the apartments and how you could control the downside and upside better than you can in the situation of, let's say, a REIT, where the other people are calling the shots there. You're hoping that the people that are managing those funds and managing those are making the right decision. It's kind of like the stock versus, real estate, tangible real estate property. What would you have to say about that?
I kind of disagree on that. I think that these managers are very, very great. You're not dealing with fund managers that are charging you crazy fees. You're dealing with geeks and nerds that are analyzing balance sheets, analyzing deals, analyzing everything from within every single REIT in the market just to create that portfolio for you. And typically how these index funds and things like that work is they're just taking a balanced approach, a weighted approach into the best and biggest REITs in the market, right? Or the biggest companies in the market when you're dealing with index funds. And that strategy, as John Bogle has proven over his life, and unfortunately passed away a couple of years ago, is the godfather of index funds. Has worked very, very well. Just stick with the winners, and it works out very, very well. So I tend to disagree on that. I think that, yes, you have more control when you're dealing with physical property if you own the entire deal. So if there's the deal that my first deal, if it's a 32-unit building, if I owned all 32 units, I have complete control over that. But I didn't own all 32 units. Some of our investors own the other units, right? So you never know what's going to happen in that scenario. Luckily, in that one, what we were able to do, because our management agent was also the management agent for all of the investors, We managed to slowly and consistently increase the rents for that entire building by just releasing certain units and pumping the rent up by 15, 20% each time. Right. So in that scenario, yes, we had control from a rent perspective. But for most normal people, you don't. You don't have that. If you own a house on a street, you don't own the street. What control have you got?
Right. Right. Well, it sounds like you've got this great, educational focus going on. You're also a private investor. What's sort of ahead for your business? Perfect portfolio. Where do you see your company going in the next 10, 20 years?
Very simple. I see me continuing to work with 155 clients, new clients a year. And I see me helping them and enjoying their portfolios grow. I have no other desire from the education side whatsoever. I spoke on a stage in the single biggest event venue in the UK, probably in Europe, the O2 Arena. People can Google it. I spoke at that event alongside Richard Branson when I was 22 years old. I have no more fantasy about what I want to be as an educator. I achieved all of that. My main goal at this point in terms of my own personal life is to structure and continue to structure my own investments in a way that they just continue to grow slowly and stably with the philosophies that we teach. As far as clients go and the education side goes, I just want to continue doing what I'm doing. I have so much fun. I meet such great people from all different walks of life. We have clients that are ex-Wall Street traders, farmers, single moms, all just such a wide variety of clients. And it's so much fun to have them go, holy shit, this thing actually works for everyone. And it works the same way for everyone. And that to me is really, 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 really rewarding. So I just hope that I get to continue doing that.
That's great. That's great. Evicting a tenant can be painful and cost as much as $10,000 in court and legal fees. The best way to protect yourself from evictions and bad tenants is to screen your tenants. And the best way that I know to screen your tenants is SmartMove. SmartMove is part of TransUnion, a trusted consumer reporting agency with more than 4 decades of experience. They built an online screening service for independent landlords that delivers critical credit and background reports to you in minutes. It is a valuable tool to help you when you are trying to decide who to put into your rental property, and they can help you find your next great tenant. Only SmartMove has a credit score built specifically for rental screening called Resident Score, which can identify eviction risk 15% better than a traditional score. With the SmartMove report, you'll also get a criminal background check, eviction history report, as well as a full credit report. And only SmartMove has Income Insights, a report enabling you to analyze renter income to determine if further verification is needed. See why 9 out of 10 users recommend SmartMove, and more than 4 million landlords have used SmartMove to make better leasing decisions. SmartMove has a special offer just for Old Dog listeners. Go to tenantscreening.com, enter code OLDDOG25, and you'll get 25% off your next screening. That's tenantscreening.com. Use code OLDDOG25 at checkout for 25% off your next screening. Smart move. Reduce your risk of non-payment and evictions. Our time is zipped by faster than I had anticipated here, so I'm kind of I have way too many questions for this interview, but we have a portion we call right now our Wrap It Up, where it's sort of a lightning round, where I ask you a series of quick questions. You respond as best as you can so that you could share resources that have been valuable for you, so that our listeners can benefit from that. So if you're ready, are you ready for our Wrap It Up?
Let's do this.
Okay. Favorite real estate book?
Rich Dad Poor Dad.
That's a tough one to top.
I read that ages ago. It was one of the first books I read.
I love it. You still bought the Bentley, you're supposed to only buy assets that produce cash flow.
Listen, I said I read it. But, one thing I've come to learn is that words don't teach, only experience teaches.
You're right about that. You got that. How about your favorite just general business book?
I would say that, this is a bit controversial for all of your listeners, I think overall as a business, how to position yourself, it's got to be art of the deal by your current president. Taking away every one of his political rhetorics, I don't stand with an opinion on that. I'm an investment guy. I look at the investment side of stuff. But I think his book, The Art of the Deal, if you can get away from whether you like him or don't like him, I think that's a really, really, really great book from understanding business and how to approach business from a classic.
Yeah, definitely a must read. How about most valuable website for success other than your own, of course?
Yahoo Finance.
Oh, great. Man, that's quick. How about favorite app? Anything on your phone that helps you out in your business?
Charles Schwab and the Interactive Brokers applications. And my banks. Basically anything where my money is, I need to know where it is at all times and what's going on.
Gotcha. How about a favorite quote?
Oh, well, if you don't stand for something, you will fall for anything.
I love it. Great quote. Okay, and this one, sort of one you're going to have to think about a little bit here, or maybe not. If you lost absolutely everything you had, all your investments, everything is gone, and all you have is 1,000 American dollars in your hand, what would you do with that $1,000 to recreate your investment portfolio?
$1,000. Wow, that's a lot of money. I wouldn't do anything with that $1,000. Everything that I've ever done started with no money. So that $1,000 I would put away and hold, and it would be safe, and it would probably pay for my Uber fees to get from meeting to meeting. And I would go and figure out a way to create money out of thin air like I've always done. The first deal that I did, like I said, $1,500, 1,500 pounds down, which I could have borrowed from anyone by showing them the numbers of that deal, and they would have taken the risk on that. The the education businesses, we set up an event and had that rolling before we actually did anything, before I even had a business card, spent any money on that. I mean, if I lost, I guess I could buy a MacBook with that $1,000, right? Or maybe go to the library and borrow one. But that $1,000 would be pretty safe with me. I mean, I wouldn't spend it to make any money.
Okay, so it's really the contacts, the connections, the relationships that really.
Yeah, if you've made money, like the most valuable thing once you've made money is not the money. It's everyone and everyone and everything to get to that money. So it's not. I hate that. That question is a very interesting question because it's really great to pontificate about that question, but it's not real. If I lose everything that I have, I can call someone and say, "Hey, can you lend me, $500,000?" and it will be in my account.
Mm-hmm. Right.
So the contact is the contacts are what you're doing this for. The friendships is what you're doing this for. The knowledge is what you're doing this for. You're not doing this to just for the money, because the money doesn't define you. You as a character and as a person, and who you help and who you benefit, and the strategies you can put together, and the creativity that you approach this with, is what defines you.
Good answer. Well, Minesh, we have a lot of folks that have listened and are, I'm sure, very interested in a lot of things you said. How can people find out more about you, your company? I don't know if you have a newsletter or anything, or some way to connect with you.
Well, you can go to perfectportfolio.com. We have trainings on the three investment vehicles that we use, and it's particularly the real estate one. It's pretty good. You'll be able to get a lot. I go into the ETF that I mentioned more. You can go and figure that you can everything. Basically, if you want to get started, we have enough free training out there to help you get started. As far as connecting with me, that's unfortunately not possible for anyone who's not a client. I'm not a fan of social media. I don't believe in that. My purpose on this earth is to take care of my friends and my family, which is what I do with my own investment, and then to take care of my clients, which is what we do through the business. And so that's how you get in touch with me, which is becoming a client. I'm not a social media guy. I don't know how posting pictures of my husky and what I've eaten today is going to help you make money. My job is to help you make money, not to like my pictures.
That's great. Good answer. We have a tradition here, and that we're called the Old Dogs REI Network. So our guests always get the honor of being able to actually close us out with their best old hound dog howl. Okay?
You know I'm not American, right?
I know you're not American. Okay, so but you've heard dogs that howl, right?
Yeah, I've got one that howls.
Okay. Oh, you got a husky. What are you talking about here?
Husky.
Right? So just go ahead and just give us your best old husky howl, okay?
This is going to be hilarious, considering I'm in an office right now. That's going to be fantastic.
Oh, hopefully people will open the door and or call 911.
Well, I guess he would. I guess. Well, I mean, have you got to do this with me, or is it just me on the line?
Oh no, this is just you, man. We have a contest.
Fantastic.
We have our Golden Howl Awards. I mean, if this is good enough, you might even get into the contest. Who knows?
You've got to send this once we get this. We got to send this because my team's going to love editing that bit out and just using that against me all the time.
No, they're going to keep
fantastic.
it in.
All right. So how would I'm trying to imagine how my husky would do it. I think he'd probably go with something like. Is that good enough?
Oh, that was good. Very believable. Very believable. No, that was authentic. That was.
Do you know why though, Bill? It's because whenever I walk into the house, me and my husky have to spend 15 to 20 minutes howling at each other. Otherwise, it's not. Otherwise, it's not a flow.
I love it. That's great. Well, man, Minesh, I can't thank you enough for being on today. It's been great
pleasure.
having you. And I also want to thank all our old dog listeners out there, too, for joining us. I know there's a lot of other things you could do right now, but the fact that you've taken the time to join us means a lot, and we greatly appreciate it. Please note, everything we talked about today is available in our show notes, our detailed show notes that we will have with links to some of the references that he presented as well at the Old Dogs website at olddogsreinetwork.com/blog. Just look for the episode with Minesh Bhindi. Well, that's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.